We're glad you joined us today. What we're going to talk about is the agricultural net income situation for property tax calculations. I think it's always good to review how the formula works. We're in a situation where the landlord net incomes for property tax calculations are going down. And certainly there's always a cause for discussion when the market value values put more difference than the use values. And so when those begin to diverge, certainly that creates issues. I serve as department head at the Department of Agricultural Economics, and my co-author on this, or helped me pull the numbers together, is Leah Sudel. Leah works kind of in the use value appraisal part of the department where we do some of the calculations. What I want to do today is cover this in terms of three topics. One is kind of a paradox between the expected returns to land and property tax appraisals. Certainly that paradox is land moving up and property tax values moving down. What is causing that? The second is how the landlord net income is calculated for property tax considerations. This is determined by statute and by directive from the property value division. And so we'll go into that. And then we'll talk a little bit about the current situation and just maybe where we are moving forward. One of the things that I will use is I'll use the kind of counties from various parts of the state. I think it is important to realize that in general, there will be some differences, and we'll kind of talk about some minimum maxes with regards to changes in property landlord net incomes from this year and last year. And so looking at this, this first slide here basically looks at the NAS cash rent value data for Barton County, Kansas. This is in the center of the state. And one of the things you'll end up looking at, 2011, it was 3650. It increased to 2014 and 4650. In 2015, there's not data. And so that kind of creates an issue with regards to doing methods in other manners. Certainly not having data from time to time creates difficulties in mass appraisal from a use value perspective. Then the cash rent in 2016, 2017 went from 4750 to 4650. In 2018, there wasn't data again. And then in 2019 to 2021, it decreased. And then there was a pretty big bump up in 2022 to 50/50. And then 2023, the most recent numbers were 53/50. This next slide basically looks at comparing the landlord net income for Barton County with the cash rents. And so from 2011 to 2024, these were the landlord net incomes that were calculated. Again, you can still see the space when data wasn't available. And you can see that there are times where essentially the landlord net income ends up being less than the cash rent. And then there's times, for example, 19, 20, and 21, where actually the landlord net income is greater than the cash rent. And so it's important to understand that when people do mass appraisal, one of the things they desire is some smoothness in the computations, such that it makes it easier for the taxing authorities to have some smoothness there instead of values jumping around from year to year. Certainly that makes it difficult or more difficult to set mill levies and that in order to raise the income levels they are or they were. But in terms of looking at this, at least in Barton County, There have been cases where the landlord net income ends up being higher than cash rent, and then the landlord income be lower than cash rent. We will also talk when we look at the statute, and we'll kind of move into that. This is essentially the statute that establishes how use value is done. In terms of looking at this, there's a couple methods. There's one for irrigated and non-irrigated land, and then there's another method for pasture land. For non-irrigated land, it's the share of net income from land in the various land classes within a county or a homogeneous region normally received by the landlord. It shall be used for the basis of determining agricultural income for all land devoted to agricultural use except pasture or rangeland. And so again, there's a divergence in the statute between agricultural or irrigated and non-irrigated land in pasture and rangeland. And so we'll go over both of those, but because of this divergence, it is going to be associated with that. The net income normally received by the landlord from such land shall be determined by deducting expenses normally incurred by the landlord from the share of gross income normally received by the landlord. And so that normally process is pretty important. And then the net rental income normally received by landlord from pasture or rangeland within each county or homogeneous region shall be used as a basis for determining agricultural income from such land. And so the key thing to realize is there is a difference between how these are calculated for irrigated and non-irrigated land. And then there's a difference with regards to how it's calculated for pasture and rangeland. The net rental income from pasture and rangeland shall be determined by deducting expenses normally incurred from gross income received by the landlord. Commodity prices, crop yields, and pasture and rangeland rental rates and expenses shall be based on an average of the 8 calendar years immediately preceding the calendar year, with which immediately precedes the year of validation or valuation. What this basically means is, for example, in 2024, to set those property tax values, the data for 2023 is not available, and so the data is going to be used from 2022. And so one of the things I think to remember is there's always kind of a couple year lag with regards to where the data is with the year that property taxes are determined, or the values for those property taxes are determined. And so the information that is used to compute the 2024 values are 1920 or 2022 data. And for 25, it'll be 23. And so there's always a 2-year difference there. And basically, it's just the time to get that data available. The other process that is important is you have the numerator that determines the landlord net income, but then you end up having the denominator, which is divided, or essentially you take this interest rate in order to capitalize that landlord net income into land values. And so looking at this, at one point, it was based on the borrowing rate, federal land bank loans, and that would have occurred on July of each year, 5-year period. Essentially, there would be a percentage added on to that of 0.75, but not more than 2.75. However, the statute was changed in 2003, basically indicating that the capitalization rate is going to be between 11 and 12%. If you look at what's going on from what a market capitalization rate would be, a lot of that is in the 3 to 4 to 5% range. And so the capitalization rate is quite a bit higher than what's in the market. That kind of, in some respects, and it'll get a little bit with regards to John's question in terms of how the landlord net income will get into that a little bit more. But in some respects, it's important to realize that the way the capitalization rate is set, even though, for example, the landlord net incomes may be higher than cash rent, it's important to realize that the capitalization rate, because that is so much higher than the market, essentially that's likely to prevent the use value for agricultural perspective to ever go above what a market land value would be. In terms of expenses, those are going to be typically occurred in producing the plants and animals and horticultural products, including management fees, production costs, maintenance and depreciations of fences, irrigation wells, irrigation laterals, and real estate taxes. Essentially, all of those are kind of taken into account. However, shall not include expenses in providing temporary or permanent buildings used in the production of such plants, animals, and in horticulture. And so it's going to be involved in the expenses used in producing those. The other thing I think that it's important to realize is that in order to do this, at least for non-irrigated land on a county-wide basis, there also is a minimum of 5% of the land needs to be grown to that crop. And so, for example, if there were some horticultural production in a county that did not end up to be 5% of the total land used, essentially that would be eliminated, and essentially the land would be valued on what's commonly grown within those regions. And so that 5% threshold is important. Where that somewhat becomes an issue is there, for example, cotton is coming into Kansas in some of the counties. And so there are counties where the cotton threshold is right about that 5% level. And as 5% of the cropland is in cotton, that would then enter into the calculation. And so essentially there is an ability for crops to enter or exit based on 5% of the land being used there. And so maybe to summarize the definition of landlord net income more in a layman's term and as opposed to legalese, in terms of the process is that the landlord share is computed based on the income generating capacity of that land and then also the expenses. And essentially, this is calculated on an annual basis, and so you're going to have some variability based on prices from year to year and based on expenses. We do adjust for different soil quality, and the way that this occurs is that there's a weighted average of the soil quality, and that then is normalized by the average landlord net income. And so higher quality soil will be valued or will have a higher land net income or landlord net income than lower quality. And higher quality soil will have a higher LNI than the average. And so each of these is normalized on an annual basis such that the average LNI for the county is equal to the average LNI that's calculated. And then there's productivity measures of the land that are regularly reported by the federal government with regards to how those different qualities are adjusted. One of the things I think that's important to realize is that data is becoming more difficult. There was just an article yesterday where Farm Group was kind of concerned with regards to the fact that less yield information, less production, less acreage information is going to be reported on a county basis. And so the concern and has been in terms of how do you get the county yields. Essentially, in 2016, the process that the state used simply because of the number of holes with regards to yields, both for irrigated and non-irrigated land, was to move to county average T yields that are obtained from the Risk Management Agency. And in some respects, this is going to be more of an expectation rather than actual yield. One of the things that this will do as we move through time on calculating this is there's going to be less variability based upon what the actual yield that farmers received. And so the main reason that this needed to occur is that there was not documented yield data in certain counties, and the goal of the process that is used is to use documented sources. And so some of the sources of data come from surveys that the department does in conjunction with PVD. Those are posted on agmanager.info. And so if you want to see how that data is calculated and computed, we do kind of surveys on a rotating 3 or 4 year basis to make sure that we're getting the common lease arrangement on a cash share on an annual basis to make sure, for example, that we have a good indication of what fence costs are, what the typical share of expenses that the landlord pays. In some respects, certain counties will have more fertilizer shared, other counties will not. And so that information is calculated through survey information on a periodic rotating aspect. One of the things we already talked about is the crop mix is only made up of crops with regards to 5% or more of the total planted acres with regards to that. Rich posted there in terms of where, if you want the survey information, again, all of the surveys that are done by the department are publicly available, such that if there's concerns with the information, at least you know how that information was gathered. One of the other things that is important is government program payments are excluded. And over time, essentially, government program payments can be a pretty important part. Government program payments will be bid into cash rent, which probably also alludes to John's question in terms of if government program payments are not in there, then it's even more difficult to believe how the LNI can be higher than rent in certain years. The other thing that is excluded is crop insurance transactions. They are excluded. One of the things in terms of thinking forward, as the T yields become more ingrained in the calculations, the fact that crop insurance transactions are not included is probably less of an issue going forward than maybe it had been in the past. And so certainly that is there. Again, it's an 8-year average of an 8-year average to the landlord to essentially smooth the information. And again, that 8-year average is then going to be capitalized at between 11 and 12%, which is the statute defined capitalization rate. The process places the weight on the middle years. Again, this is designed to have more of a smoothing effect on tax values. And the landlord net income made up of the last 15 years is included there. So, for example, the 2024 values are 2008 to 2022 data is made up with regards to that. And so the weighting process essentially is in a triangle where the most weight is going to be placed on the middle years. And so as you get further out, there's not a lot of weight. And as you get further in, those years pick up more and more weight. And so if we just did everything at 1/8, there would probably be more movement in the LNIs from year to year. Because it's using this smoothing process, individual income years do not have as much weight on that. And so that's the idea of that regarding that. And so to look at this, what we ended up doing is calculating from 1998 to 2022, a single year LNI. And the thing is incomes from a farm perspective are extremely variable in Kansas in terms of we have Barton County, where from 1998 to 2005, farmers were having an LNI of between 20 and 30. In terms of then, essentially the farm economy got a little bit better. And so those LNIs jumped very quickly from 2007 to 2008, roughly from about $30 to about 72. And again, if you would basically just work that in as 1/8, you would see a huge increase in the values. But then farm income declined very quickly from 2008 to 2012, from roughly 70 to 40. And then in 2013, farm incomes essentially doubled from $40 to $80. And then they ended up dropping all the way down to 15, and stayed there for 2016, 17, 18. 2019, they increased a little bit. And in 2021 and 2022, they're up about 60. And so in some respects, if you would just take an 8-year average there, depending on the year that was entering and the year that was going off, you could have substantial jumps with regards to that, even when you're dividing by 8. And again, a lot of this is just going to be due to the variability. And we can begin to compare that with the LNI. In some respects, it's a smoothing effect over that, such that there will be years where the LNI is higher than the actual income, and there'll be years where the LNI is lower than the actual income that farmers received. But again, it's kind of a smoothing process to kind of keep those values moving on a regular basis. And again, just to give an indication in terms of the LNIs, in terms of you can get fairly large increases. For example, 13, 14, 15, there were 10% increase in the LNIs. And essentially, you can get fairly large decreases in terms of -1, -2, and essentially from 23 to 24, it was -12% from year to year. And so even with the smoothing process, there can be aspects there. But to give you an indication of how this works in terms of, we've kind of put this weighted triangle there where you can see most of the weight. In this one, most of the weight is going to be on 2005. And you can see that weight goes all the way up to about 12.5% in the middle. And then it's just a little less than 2% as we bring years in and years out. And so in terms of looking at this, this was the weight for the 2014 data. And you can see that some of those high level years were not at their maximum weight yet in terms of moving through. And so as we move through to the 2015 values, you can kind of see the numbers that begin to rotate off and the numbers that come in or end up being a little bit higher. And so for 2015, we got the huge income of 2013 that was coming in. And so essentially, as we go through this, you can begin to look at when the peak weight is and the numbers that are rotating in and rotating off. And so in 2016, we have a little bit of the really low income years from 2016 begin to come in. And again, we just begin to move forward to that. You can see, for example, that the 2008 is getting less and less weight as we're more current. The 2013 is getting more to the peak. And last year, or in 2022, the high income of 2013 essentially was on the peak. And now, essentially, that number is carrying less and less weight. And so unless we end up with really high incomes, what we are not seeing in the 21 and 22 data, essentially that fact that we're unwinding out of the 2013 high level years is causing the land values to end up going down. And so I think it's important to realize that you're just kind of working through on a year-by-year basis with regards to where that is. If we look at Barton County, we can look at other parts of the state, and I've taken something from the far west, which is Greeley County, and then I've taken Donovan County, and then we can compare it to Barton County. One of the things to look at is when you look at the scale, Barton County has a lot of variability, but then you look at what we're dealing with Donovan County, where the numbers are a lot higher and there's just a lot more variability with regards to the income. Then you look in the western part, and so essentially there you have less variability, but the numbers are very low, and in some cases the individual years actually end up being negative simply because of expenses and prices and income. And so in some respects, the process from a state perspective is set up to kind of deal with the extremely different variability from county to county. That's where kind of the smoothing, because otherwise you get in parts of the East, you may end up having extremely variable LNIs going from year to year without a smoothing process. And again, just kind of looking at this kind of where we are for 2014, this is kind of the weights that we have on these. And essentially, you can kind of begin to think through how this triangle weighting matrix will move past or move through the individual years variability. And so the variability when you use a use value based on a landlord share is extremely high. Simply because that's the economy that farmers produce. In terms of looking at this, in terms of I picked a county out of each of the crop reporting districts to get an indication on what's going on with non-irrigated, irrigated, and pasture land. And essentially, you can look at the numbers in terms of what those were in 2022, the LNIs, and then how they changed in 2023 and 2024. Essentially from 22 to 23, there were drops in the LNIs. And then from 23 to 24, there are drops in the LNIs. And again, those from 23 to 24 were a little bit higher than where they were. You get out in the western Kansas region, because those numbers are so low, in terms of a small change of $1 or $2 really causes big changes in the percentage. But if you look at each of the districts, you see that the LNIs are declining. Couple things in terms of part of it is due to just the weighting and the fact that we are taking off 2008 and 2013, which were extremely high income year for producers. The other thing is, I think it's important to realize is that a lot of the income in 2021 and 2022 were from government farm program payments. And essentially, the statute basically does not include government program payments in those computations. And so what that ends up doing is we have some low LNI years coming in because a lot of the income that farmers received was from government program payments as opposed to the market. We'll come back to a slide there a little bit, but that's kind of why these values are kind of in a stage of decrease. If we look at irrigated land, again, you can see the percentage change from 2022 to 2023, and then from 23 to 24. And so essentially the base values upon which these are calculated, and it's important to realize that the capitalization rate is not adjusting. And so while we're seeing the interest rate adjust in the market economy, we're not seeing it in the LNI simply because by statute, it is determined to be 11 to 12%. And so again, that does kind of affect how these translate to that. And then we look at on pasture. Pasture is done more on a district level as opposed to a county level, simply because the data isn't there for county pasture rates. And so we do all the normalization on a crop reporting district relationship. The other thing, because we're using cash rents there as opposed to landlord net income, you don't see the wild or the bigger swings that we see in the crop, whether it be irrigated or non-irrigated. And so again, cash rents, because they're forward-looking, tend to be a little bit smoother than what farmers realize on a historical basis. Simply when those rental contracts are established on a cash rent perspective, it's a forward-looking decision. And so in some respects, normal variability is there, and those contracts are determined more on a normal basis, indicating that some years the rental rate will be too high, some it'll be too low based on what the actual crop was at that point. This is kind of a map, and it's kind of difficult to read in terms of where the counties are. I kind of summarized this, but one of the things that is important to realize is statewide on a non-irrigated basis, everything is going down. That's a little bit different than the pasture. And so from a non-irrigated space, each of the counties from 2023 to 2024, the LNIs decreased. And again, it's just the fact that the cycle we are in is we're beginning to place less weight on 2013 and 2008. And so essentially each of the 105, ignore that second point, that should be deleted in terms of all of the counties decreased. In terms of 2024, if we look at the irrigated, essentially I use a 200-foot well depth simply because it's more consistent. Obviously in some regions 200 foot is shallow. In other cases 200 feet is a deep well. But again, on irrigated land, essentially everything is going down. The changes range from -821 to -2660. And on a percentage basis, that was 12.4 to 28.1%. And then if we look at pasture, it's mixed. Native, and again, this is on districts. The native pasture LNI is decreased in 4 districts, remained the same in 1 district, and decreased in 4 districts. The change was -63 cents to 31 cents for native. And that was a -10% to 4.4% is the change from year to year. And then if you look at tame values, essentially those all increased, and essentially those range from 19 cents to 122 for a percent change of 1.5 to 7.3%. The last thing I wanted to visit with, and then we'll take questions as we move forward. But this here basically looks at, and this is Kansas Farm Management Association data. And I went back and did an average from 2016 to 2022 in terms of looking at what the average market income was and then what the average government program payments. And these are statutory Farm Bill program payments. I do not have any of the crop insurance stuff. That would be what I refer to as market. And I took essentially this 7-year average and kind of looked at, okay, what is the percentage or what is the dollar amount coming from the market per farm, and what is government program payments? And so the way to interpret this is on a statewide basis, roughly about 84,000 is from the market. Essentially, there's another 55,000 average government program payments. And so that gets the net farm income on a statewide basis over that 2016 to 2022 period of $140,000. And again, looking at this, you can see obviously that government program payments are extremely important with regards to this. Total income for the Northwest on an average basis was a little over 160. The Southwest was a little over 180, and the South Central was a little bit over 120. If you want to think about this on a percentage basis, I have it here on a percentage basis where essentially what this says on a statewide basis, roughly 65% comes from the market, 35% comes from statutory government program payments. If we look at the Northwest, it's about 50-50. If we look at the Northeast, it's about 70-30. And so you can kind of see the importance of how the LNIs are affected by not including the government program payments in there. And then this basically is looking at it kind of what the net farm income would be without government program payments. And you see variability across years. And so you can follow, for example, the yellow in terms of 2016. Without government program payments, farmers in Northwest Kansas lost about $50,000. But in 2021, they ended up having a farm income without government program payments of about 325. And so if you look at the same color year over year, you can see just the variability in that income without government program payments from year to year. But also, for example, if you look at the numbers within a year, you can see there's quite a bit of variability within a year. And so for 2016, there were 3 regions within the Kansas Farm Management Associations that had negative market income, and there were 3 that had positive market income. And so again, there's a lot of variability across the state just due to prices and crop mix and how those things fare, the expenses in that. And so the variability there is extremely important. And the question is sometimes, why isn't there a system to move to cash rent on non-irrigated and irrigated? Simply that would smooth things a little bit, kind of like pasture. The issue is the data is extremely variable across the state with regards to whether or not cash rents are available. In certain regions of the state, cash rents are very uncommon. In other parts of the state, cash rents are very common. And it's very difficult to get cash rent basis on a district level, very much more difficult to get it on a county variable. And certainly from a cropping system perspective, there's probably more variability from county to county within the crop production range with regards to that. And I think it would be possible, for example, if the legislature wanted to open the statute, would be to move to a cash rent based system. The key there, which would become an issue, is that those would probably be a regional basis. And so whether or not the variability with regards to across the crop reporting district, whether or not that would be too much or not enough. But again, that's a decision for policymakers to end up making. As we look forward in terms of, I think probably we're going to see a decrease in 2014 or 2024 and 2025 as we go forward. If you kind of look at how those triangles are there, we are taking off and weighting less some high income years. And if we look at 2014 and 2015, given market prices, it appears that they're not going to be high income years for farms. Couple things could change. Obviously, prices could increase on the world economy, and then also input costs could decrease. And so it doesn't mean there won't be any change, but certainly there are aspects with regards to that. And so farm incomes are probably going to be stressed due to crop market prices and high input costs. And then the other thing that we talked about and where those triangles are useful is those high incomes are going to carry less weight as we're going forward. And this is going to be both for non-irrigated and irrigated. If we look at it from a pasture perspective, they're probably going to be fairly stable over the next few years with a small increase. And so with that, hopefully this has been a helpful overview in terms of what's going on. Certainly we can take questions with regards to that you may have. Certainly many of these are more policy debate questions, and it's good to recognize that this is a legislative statute that drives these. The key thing that PVD has always kind of talked to the department as we've done these over time is to make sure that any numbers that we put into the calculations are documentable, such that as a taxpayer in the state of Kansas, you can be assured that these numbers aren't being subject to manipulation with regards to where the values are coming. Everything is a very formulaic type process. But certainly the variability within the state of Kansas causes these numbers to be more variable than maybe some other places. And Terry has a question, and I don't know, Rich, whether or not you want to allow people to ask questions on the mic. I'm okay with that, but if we can't do that, that's okay too.
I can
Terry
go ahead and open
has
it
a
up.
question: which political group do you believe would complain in the face of declining LNIs? And again, it's important to realize that whatever number comes out in an LNI, there's going to be groups that are unhappy. In terms of, obviously, a farmer is okay with the LNIs decreasing, realizing that at least from a use value appraisal, that will perhaps result in less taxes. In terms of certainly those that are more that do not own land within a county, and so those in the towns would be unhappy with the declining LNI simply because there's a tax base there. It is important that county commissioners adjust the mill rate, and so they can move that up or down to get the taxing revenue that they need for their schools, their local governments, those types of things. And so that can move the mill rates. And so in some respects, some of this variability can be handled with regards to mill rate adjustments, although that's never a popular type thing with taxpayers when the mill levy changes. But certainly those that are operating county governments and those that are operating school districts probably are somewhat unhappy that they're going down simply because that will indicate a need for perhaps adjusting a mill rate up within a county. Again, my guess is from a political perspective, I've never been a commissioner, never been on a school board, but my guess is that raising those mill levies would not be a fun meeting to be in with regards to that. And so the thing is obviously if all the counties are rural, in terms of those revenues have to be raised, and the way that will probably occur would be adjusting the mill rate. If you're in a county in the eastern part of the state or where there's a lot of urban, essentially the tax base for a few years will shift a little bit from agricultural aspects to urban aspects. And so again, that's kind of the politics that you would want to think. So hopefully that's helped with that question, Terry. John kind of got into the question with regards to the mill levy. Obviously, you are correct in terms of, I don't know if I need to come back with that or whether or not I kind of answered your question when I was answering Terry's question. But come back, John, if you want more discussion on that.
Let me ask another one, Alan. I don't know if you can hear me. I take it off mute. Can you hear me all right?
Yep, I can hear you.
Okay, my question is, has there been any clamoring for, or has there been any research comparisons of other state methods, since they all make concessions to agricultural land for farming, especially neighboring states like Nebraska, for example. Has anybody looked at the smoothness of their approach compared to, say, the smoothness of Kansas' approach?
Yeah, in terms of there are certainly some differences across state. Nebraska is one that is quite controversial in terms of my wife actually owns a little bit of farmland in Nebraska, and she's a native Nebraskan. And when we end up looking at her taxes, they do theirs more on a market value. And so they do make a few concessions with regards to they kind of take a little bit of the top out of that. But essentially, their tax rates are quite a bit higher, probably more double. If you kind of look at the border counties between Kansas and Nebraska, essentially the property tax burden is a lot less in Kansas than it would be in Nebraska. Other states with regards to that, some of them will do a more of a cash rent system on the non-irrigated and irrigated land. And so as you go more east in agricultural counties, it's easier to get crop data in terms of cash rental rates, where they're becoming more common in Kansas, but they're not there yet, especially in the western part. So we're kind of looking at that. But in terms of a market value approach, kind of looking at actual land sales and then putting a mill levy on that. And then, as you say, they do make some concessions to agriculture. Whether or not it's enough or not is a political question. But there are, most states use some type of use value aspect to fund their aspects. And probably the big play in a lot of the states is the rural urban share of taxes that are collected through property assessment. Does that help, Terry, or do you want me to go more?
No, that's fine. I was just, when I think of the work that's done in with the agricultural managers and rural appraisers data, where we're getting a little bit better data, say at the county level on values, and I just always wonder if there's ever been a push, given that information, of just say picking an arbitrary percentage below that number and call that the use value number. You know, whether there's been any pressure because of the intrinsic unsmoothness of the data, I guess.
Yep. And that's good. And again, in terms of, and I'm not going to take a position one way or the other, but in terms of cash rent, in terms of whether or not there's hunting rights or solar rights or wind rights or those, in terms of there's that whole discussion in terms of when you're looking at rents, how do you separate that out of a cash rent if there's wind on a system, or what different ownership rights, whether or not that would come with it or not. It's the big thing, I think, is getting data that's defensible and such that people can be reliant on the fact that that's good data. And perhaps as we get more cash rent data within the state, that may end up being a way to end up moving. In terms of Nikki has a comment there. Wouldn't market value put more stress on farmers who do not want to sell property but to keep it in family farms? The big argument, especially as you get towards more urban encroachment, is that at some point land has development rights bid into it, and essentially that does place stress on farmers that would farm near urban areas, that essentially if you use some type of market value, they would be paying tax on potential urban development. And it could place stress on producers, as you see, that may go ahead and sell some of that to capture those development things with regards to that. And so that is the philosophy behind use value, and just trying to look at it from an agricultural perspective and to separate some of those non-agricultural development rights that will appear in different parts of the state. Obviously, if you're in certain counties, it's like, there's no development pressure on any place in this part of the county. But as you go from county to county, that's there. But certainly the argument that you present, Nikki, is correct in terms of especially for those where there are significant development rights, a market value would place stress on those with regards to that. Yep. And so there's some of that will drive prices. But again, this is more of a political question in terms of just how, as constituents in the state of Kansas, we kind of want to tax agricultural land. And again, at the university, and I think at PVD, we're trying to keep out of the politics and basically just do it according to statute. And so if there would need to be changes, the statute would need to be opened up to make changes if that would make the system better. But the key thing, I think, in terms of making some major changes is just the quality of the data that would be available to make the system defendable, such that I think people sometimes may not be happy with what's going on, but at least knowing that the process is formulaic driven as opposed to politically driven or anything like that, I think hopefully gives a little bit of an assurance that, again, I may not like it, but at least I understand that it is formulaic driven with everything being documented, which I think has caused the system to be fairly stable since I think the mid 80s or early 80s was when this process came to be. Other questions or comments? Again, we appreciate you jumping on. And hopefully this explains the process. Again, like I say, you may not like it, and you may have political aspects, but the big thing there is data is pretty expensive. And believe it or not, people in general are less likely to provide survey information. And so the rental market is extremely private. And so whether or not you could get farmers to, or anybody to respond in terms of what the rental rate is, I think that would be kind of a tenuous survey in order to get nationwide cash rent surveys are just not very robust in terms of it's hard to get people to respond to those. Land values are probably a little bit more easy to get, and essentially there's information on parcels that transact in Kansas that is collected. And so certainly from a market value perspective, actual transactions on land sales are there. But on cash rent, it's difficult. And one of the reasons we're seeing those end up backing out is it's just getting more costly and costly for the government to do it, in the reliability factor, because people are less willing to answer surveys than previously, is getting less. And so the US government, the reason they're backing out of some of this survey type stuff is they're really concerned about the reliability of whether or not it's representative or whether or not it's a biased sample. And again, if you're going to do cash rent or collect any more data, you want it to be representative as opposed to have some sample bias in that in terms of who who reports or who doesn't report. But data collection is a huge issue for USDA, NAS, and I just saw an article yesterday where the farm groups are concerned that production yield and acreage information on a county basis is going to become less and less. In terms of, Steve has a question, do we use farm management data for cost factors? We do not. In terms of, essentially, we made a decision when the calculations moved from PVD to Kansas State that we would not use farm management. There's a couple of reasons for that. One is that we're not sure that farm management is a totally representative sample, in terms of we don't have the very small farmers, we don't have the very large farmers, and so we try to get more representative samples than the farm management. And again, I'm not downing the farm management data; it's extremely beneficial. And that the other thing people could argue, and whether or not this is fair or not, people could argue, well, you don't want to use that because those aren't your typical farmer; they're better than average farmers. You know, people have made that argument because they're spending more time on thinking about management, tracking data, and getting that additional analysis done that the farm management economists provide. And so the issue is, would that be fair to use that simply because if we think that there is value to thinking about farm management, that so you get better than typical returns? Would that be fair to tax those on those? And so there is no farm management data used, and that's kind of the philosophy of why we've chosen not to use that in the calculations. And so that is why we do some of these other surveys to get a broader population than just the farm management cooperators.
Terry here again. I just had a comment. As data become more of a problem, we have to all be aware that USDA is pushing more and more of relevant NAS activities over to RMA, in my opinion, as evidenced by their recent drop of reporting more crop yields all the time. And RMA data will become ever more available at the public level. And I mention that because I think two of the largest distortions in the process in recent years, and especially so in the western half of the state, have been due to the exclusion of government program payments, but more importantly, the exclusion of all crop insurance numbers, either premiums or indemnities. And so there will be publicly available data bases probably if there is a political push for some reason to change the process of the smoothing LNI calculations.
No, I would completely agree. And if we could get county RMA data in terms of, to me, I think that would be the best data there. But at this point, they're not making that public. They're not making that available. But I would totally agree with you, Terry, in terms of that would help the system. There would be going back to actual yields as opposed to T yields. T yields, again, are kind of a forward-looking thing, kind of an average as opposed to the year-to-year variability. I'm probably less concerned about not having crop insurance in there because we are using T yields. In terms of, I think there's some offsetting there from a yield perspective, not so much from a price perspective, but from a yield perspective. There's certainly some smoothing there. With regards to government program payments, again, that's just a political decision, but one of the reasons I presented that is such that on those slides, you have an indication of, at least over the last 7 years, what percentage was from government program payments, what percentage was from the market, so to speak. And again, I'm not going to wade into that political debate. in terms of, again, that's for the citizens of Kansas and policymakers to figure out. And um, uh, so we'll leave it at there. Other questions? But the other thing is, I do think there'll be more and more data in terms of it's incredible from a yield perspective what satellite technology is beginning to look at. And so as that develops and that gets more accurate with regards to how well the satellites can actually pick up via greenness and that in terms of what the actual yields are. Again, a lot of that's being used at aggregate to come up with aggregate numbers. But as that technology advances, my guess is that you'll get more and more disaggregation with regards to where that is in that. But again, we're probably looking at a decade or two into the future, maybe more than that. But I think there are ways, kind of with technology, and I think RMA would be good. But as you indicated, Terry, that would need to be a political push to get that. But I think there's a lot of information that could be beneficial from an agricultural perspective with regards to the RMA data. That's the information provided to crop insurance providers, producers by essentially legal requirements have to provide actual data that's accurate, simply because there is legal ramifications if the data isn't accurate. But in order to get that process where that's viewed as administrative data as opposed to NAS data, that would take some legislation probably at the federal level in order to make that data available. Anything else? Again, we appreciate your time, and hopefully this has helped explain a little bit what the process is. Again, it is important to realize that as a citizen of Kansas, you have an ability to affect and specify that to the state legislature that can make changes to this if that's the desire. But hopefully this gives you a little bit better understanding of how the process works. And so with that, we'll hopefully catch you on some of the other webinars that the department hosts.